Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamoan, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions. This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their home ownership dreams. Visit realapproved.ca to learn more about how their experienced team can assist you with your mortgage needs. Let's dive into today's episode. Today, we begin with a significant update from the Canada Mortgage and Housing Corporation, or CMHC, which has highlighted a concerning trend for homeowners across Canada. According to the latest data, nearly 1.2 million fixed-rate mortgages are set to come up for renewal in the year 2025. This development is noteworthy as it poses a potential financial risk for a substantial portion of homeowners. The CMHC has pointed out that approximately 85% of these homeowners initially secured their mortgages when the Bank of Canada's overnight lending rate was below 1%. This was a time of historically low interest rates, which many took advantage of. However, with the current economic climate and the possibility of higher interest rates on the horizon, these renewals could lead to increased mortgage costs for many Canadians. For those unfamiliar with how mortgage renewals work, when a fixed-rate mortgage term ends, homeowners must either renew their mortgage with their current lender or refinance with a new one. The terms and interest rates available at that time will dictate the new cost of borrowing. With the potential for increased rates, homeowners whose terms are ending may face significantly higher payments than they have been used to. This projection by the CMHC serves as a reminder for homeowners to start planning ahead. It is crucial to assess your financial situation, explore different mortgage options, and possibly consult with a mortgage broker to understand how best to navigate these impending changes. Remember, proactive planning can help mitigate the impact of increased mortgage costs. While this news may seem daunting, it is important to approach it with a balanced perspective. On one hand, the potential for increased mortgage payments could strain household budgets. On the other hand, it reflects a broader economic cycle where interest rates may rise as part of efforts to manage economic growth and inflation. In the latest financial update, the Bank of Montreal, or BMO, has reported a significant increase in its loan loss provisions for the fourth quarter of 2024. The bank's credit performance deteriorated more than anticipated, resulting in a 15% decline in adjusted full-year earnings compared to the previous year. BMO's president and chief executive officer, Darryl White, acknowledged these challenges during the bank's fourth-quarter earnings call, noting that the management of credit quality has been particularly difficult in the final quarter. BMO has set aside $1.52 billion Canadian dollars in loan loss provisions for the quarter, marking a 240% increase from the $446 million Canadian dollars set aside a year ago, and a substantial rise from the $906 million Canadian dollars in the third quarter. Darryl White emphasized that the bank continues to prudently manage its portfolio and is working closely with clients facing challenges, expecting the quarterly provisions to moderate through 2025. The bank's chief risk officer, Piyush Agrawal, provided further insights, highlighting that current unemployment levels in Canada remain elevated. He anticipates that retail impaired losses will modestly increase through the first half of next year. However, Agrawal expressed optimism that the client-specific challenges observed this year will moderate, and the overall portfolio will benefit from the impact of monetary easing and a more constructive business environment in fiscal 2025. When it comes to impaired losses, Agrawal believes that the fourth quarter represented a high point, with expectations that losses will moderate in the coming year. He cited detailed reviews of the bank's watch list and impaired assets, noting that the resolution of several large files in the fourth quarter has bolstered confidence that impairments will ease going forward. BMO's residential mortgage portfolio has also experienced changes, with 90-plus day delinquencies rising to 0.24% of its portfolio, up from 0.15% a year ago. This figure is largely in line with other major banks that reported earnings this week, such as the Royal Bank of Canada at 0.26% and Scotiabank at 0.23%. Additionally, BMO disclosed details regarding its mortgage portfolio and the status of its fixed payment variable rate mortgage clients. As of the fourth quarter, the bank still had 9.3 billion Canadian dollars worth of mortgages in negative amortization, representing about 20% of its total variable rate mortgage portfolio and 6% of its overall mortgage portfolio. This is a significant decrease from a peak of 62% of its variable rate mortgages in negative amortization during the second quarter. Negative amortization occurs when borrowers with fixed payment variable rate mortgages do not cover the full interest amount due to a rise in the prime rate, causing the mortgage balance to grow. BMO, along with other banks like Toronto Dominion Bank, Canadian Imperial Bank of Commerce, and the Royal Bank of Canada, is observing a decline in average amortization periods. The percentage of mortgages with amortizations of 36 years or more dropped sharply from 24.9% in the fourth quarter of 2023 to just 10.1% in the fourth quarter of 2024. This decline is attributed to borrowers making prepayments, mortgages resetting to their original contracted amortization at renewal, and the easing of variable rate mortgages following Bank of Canada rate cuts. BMO also anticipates that 17%, or 27.1 billion Canadian dollars, of its mortgage balances will renew within the next 12 months, with an additional 80% set to renew after fiscal 2025. The bank reported that 13.4 billion Canadian dollars of mortgages renewed in fiscal 2024, with renewing customers facing an average increase of 15% in their regular payments for variable rate mortgages and 13% for fixed rate mortgages. Despite these challenges, BMO remains optimistic about the future. The bank's earnings for 2024 included a net income of 7.4 billion Canadian dollars, although this marked a 15% year-over-year decrease. The fourth quarter's net income was 1.54 billion Canadian dollars, down 31% year-over-year. BMO's residential mortgage portfolio grew to 158.9 billion Canadian dollars, and the bank maintained a strong Common Equity Tier 1 ratio of 13.6%, reflecting its robust capital position. Our final segment today focuses on Canadian Western Bank, which recently announced a delay in the release of its fourth quarter and fiscal 2024 results. Originally scheduled for December 7th, the release has been pushed back to December 18th. The reason for this delay is a legal claim that has impacted the bank's timeline for financial reporting. In a statement issued on Saturday, Canadian Western Bank explained that the delay is due to a legal claim it is currently addressing. This claim has affected the bank's ability to finalize certain financial details for the quarter. Importantly, the bank has clarified that this issue is not related to National Bank of Canada's current plans to acquire Canadian Western Bank. The bank emphasized that it expects to resolve the issue by the new release date and confirmed that the potential acquisition by National Bank is still on track to proceed as planned. The legal claim was received late in the process against CWB Maxium Financial Limited, a wholly owned subsidiary of Canadian Western Bank. The bank has initiated a full investigation into the matter. The claim includes several allegations, notably unethical conduct by a named individual who is a sales agent of Maxium with no lending approval authority. Canadian Western Bank assured that their investigation supports that the loans in question were appropriately authorized within their credit approval process, which includes a thorough review and approval by their credit risk management team. Based on current information, Canadian Western Bank does not anticipate the outcome of these claims to significantly impact its financial results. The bank, based in Edmonton, offers both personal and commercial banking services with a strong presence in Western Canada and Ontario. As of the third quarter, the bank reported a total loan portfolio of 37.4 billion Canadian dollars, including 6.7 billion Canadian dollars in commercial lending and 7 billion Canadian dollars in personal loans and mortgages. The planned acquisition by National Bank of Canada, valued at 5 billion Canadian dollars, is expected to add 65,000 customers and nearly 40 branches to the Quebec-based bank, further expanding its presence in Western Canada. This acquisition marks a significant strategic move for National Bank as it broadens its reach beyond its traditional markets. That's it for today's episode. Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate. Before you go, a quick reminder, Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your home ownership goals. Catch you next time and stay informed with the latest industry insights.